All right. Well, we have a lot to get through. I know that people are still joining, but I want to make sure that we leave enough time to cover what we came here to talk about today and answer as many questions as we can. So I'm going to kind of jump right into it. Very briefly, for those of you who have not worked with DRS in the past, I want to take a moment to introduce ourselves. My name is Rob Hogan. I am the Director of Integrated Grant Solutions for DRS. My practice's primary function is working with states, cities, counties, tribes, territories, nonprofits who are going after grant funding for different resiliency, recovery, and response type activities. In the last few years, as you can imagine, I've had a serious focus on COVID recovery between CARES and ARPA. And, we wanted to take an opportunity to leverage some of the knowledge that we've gained over the last couple of years and share that with folks as you all are in the process of managing your own ARPA funds. And joining me today is Corey Brandt. He works alongside me here at DRS and is here to make sure that I don't run over time, because I love talking about this stuff and I will definitely take advantage of every minute that I can. So he will help keep me on track and make sure that we answer as many questions as we can throughout. So without further ado, let's jump into this. Wanted to say I am overwhelmed by the response that this webinar has generated. We had well over 200 people register. And I see that more people keep joining now. Very excited that there is this much interest in ARPA, because as I said, I'm very passionate about what I do, and I love being able to help people navigate these very complex and difficult type of grant funding. So we also wanted to thank you for responding to the pre-webinar evaluation. And one of the interesting things that came out of that survey was kind of the makeup of who y'all are. We asked you how many staff members do you have working on your ARPA administration, and over 84% of you have between 1 and 5 staff. And I am willing to bet for the vast majority of that 84%, you are the one sole staff member who's doing ARPA administration, and it's probably not your full-time job. So you've been asked to manage millions of dollars worth of new grant funding with very specific and unique rules, while also doing the other jobs that you do. So I have an immense amount of respect for what you do and want to let you know that myself and DRS are here to assist you. So let's jump into the compliance part of it. We're going to talk about compliance first and cover some of those topics. And then at the end, we'll spend some time talking about the deadlines and activities that you can start to do in order to prepare for not only the obligation deadline at the end of 2024, but the closeout deadline at the end of 2026. So starting with compliance, the first thing to keep in mind as we go through this today is ARPA as a statute included dozens of funding opportunities across the federal government. Some of the ARPA funding were for new programs like the state and local fiscal recovery funds, which will be the primary focus of what we talk about today, but also a vast array of existing programs got new or additional appropriations through ARPA. So as we kind of talk about ARPA, I know that for a lot of us, that term ARPA has been conflated with your state and local fiscal recovery funds. Know that, we're specifically talking about SLFRF today, but a lot of the principles that are in this will be applicable to the other ARPA funds that you may have received or other grant funding in general that you get from the federal government. But specific things here are unique to SLFRF, and we'll talk about those. So when we talk about compliance, we need to know what is our starting point. What is it that we have to comply with? Those of you who I got a question that people are not able to hear me. I hope that Corey, are you able to hear me okay?
Yes, I was just about to
Okay.
respond to Nadine. I think it may be a specific issue, but if anyone
Okay.
else is having an issue, please put it in the
Yeah.
chat.
Let us know. Thank you. Um, all right. So what are the sources of compliance that we need to be focused on? The number one, well, actually on par with each other, the two primary sources of compliance that you should be focused on are uniform guidance and the SLFRF final rule and supplemental guidance, right? So the uniform guidance is the applicable regulations that apply to all federal assistance that the government does, right? And uniform guidance covers grants, loans, cooperative agreements, and those types of things. It encompasses all of the rules and regulations that are important for procurement, for subrecipient monitoring, for your single audit, for cost evaluations and those types of things. So it's really kind of a key source of compliance for you. The other one is the SLFRF final rule issued by Treasury. And if you haven't done so already, I would suggest that you go to the Federal Register and download the original publishing of 31 CFR 35. And the reason that I say that is because the posting in the Federal Register includes a vast amount of commentary as to how the rules were created. And this is very important when you go to determine things like eligibility and those types of things. You want to make sure that you're using the most relevant information available the way that Treasury intended it to be interpreted. So along with the final rule, there have been FAQs that have been updated, and there's also supplemental guidance. And that supplemental guidance takes the form of project and expenditure reporting, user guides, your compliance and reporting user guide. Those all provide additional information that could be beneficial to you. The next important compliance piece is the compliance supplement. And this is an annual publication by the Federal Office of Management and Budget. And what the compliance supplement is a guideline for your auditors in performing their single audits of your entities. And for almost every grant that you have or assistance award that you have, there will be a entry in the compliance supplement that tells the auditor, here's the things that you should be looking for when you audit this grant. Here are some tests that you can do, and provide some general requirements for compliance. Of course, if that's what you're going to be audited on, it's important to know what those things are so you can plan for that and adjust your compliance activities accordingly. And then finally is the state and local rules. So your state and your local jurisdiction may have unique rules that apply to the use of grant funds. This would include things like travel and expense policies, your accounting policies. Procurement is a big one. Some of you have to follow specific state regulated procurement rules. Those are things that you need to be aware of. I'll give you an example. In the state of Florida, there are regulations around bonuses that can be paid to state employees. Those rules impact how and whether you can use eligible use categories under ARPA, such as premium pay and hazard bonus pays. But you need to be cognizant of what your local rules and your state rules are and how they interact with what the federal rules are. As you're doing that evaluation, you're going to notice that there are conflicting rules that apply, right? A common one is with procurement. the federal procurement thresholds may be much higher than what your local thresholds are. In those types of situations, you should always use the most restrictive rules. When an auditor or an examiner comes and looks at your performance of your grant, they're going to know those rules, or they should know what those rules are that are applicable for you, and they're going to make sure, or look to make sure, that you followed the most restrictive rules that may apply to you. Coming in to the next evaluation question that we asked, or pre-evaluation question that we asked, what has been the most challenging part of your ARPA award? And really, it's no surprise that procurement is the most challenging aspect of ARPA for a lot of you. Many of you may not have had federal assistance awards in the past, and most of you have not had the sheer volume of federal assistance that came with ARPA. And that increase in dollars that you're managing under the federal rules also means that there are probably new projects, like infrastructure projects, that you may not have done with federal funds in the past. So learning what those procurement rules are and how they apply is extremely important in your compliance piece. We have a great procurement team at DRS, and one of the things that they say in every presentation is 7 out of the 10 reasons why federal funds end up getting deobligated is because of procurement noncompliance. So again, cannot stress, and in the next 3 slides we'll cover procurement, so cannot stress enough how important it is to be mindful of your procurement compliance. Likewise, subrecipient monitoring is a big issue. Many of you have probably never had subrecipients under federal grants before. So this is whole new uncharted territory. And those who have may not have had the volume of subrecipients who aren't familiar with the federal rules and what they need to do to comply. So you may be in the position where you're providing a lot of training and technical assistance to your subrecipients, in addition to trying to manage your own compliance with ARPA funds. So another good area, and we'll talk a little bit more in a minute. And then eligibility determinations. One of the things that is unique about ARPA and the SLFRF funds is that, unlike regularly appropriated grants, which have a defined purpose, such as, road improvement grants or wildlife conservation grants, the SLFRF funds have a wide spectrum of eligible uses, and Treasury painstakingly wrote rules about what is eligible under each of those use categories. So as you're going through the process of saying, how do I use these ARPA funds in a way that's compliant, you have to understand what those eligible uses are and how you justify your use of fund under those rules. So again, eligibility determinations are a huge issue that we'll talk about in a moment. But for now, let's jump into procurement. So one of the things to keep in mind about procurement is there's a pretty standard flow as how the procurements work, right? You identify that there are goods or services that you need for a specific purpose. You identify or draft the requirements that those goods or services need to adhere to in order to be effective for your purpose. Then you go out and you solicit contractors or vendors to fulfill those needs and provide those goods and services. You'll do an evaluation to make sure you're picking the best one. You'll award them a contract or make a purchase, and then you have to administer that relationship. Regardless of whether you're using federal funds or not, that's pretty much a standard framework for doing any type of government procurement. What makes the federal procurement unique is there are specific methods that are prescribed in uniform guidance on how you do that procurement, right? And so one of the things that you'll notice here is there are dollar thresholds tied to each of these methods of procurement. Those are the current federal thresholds in uniform guidance. As we talked about a few moments ago, you need to be mindful of what your state and local rules are and how they apply to your use of funds, because your thresholds might be significantly less than these. So for instance, under uniform guidance, a formal competitive bidding process needs to happen if your procurement is over the simplified acquisition threshold of $250,000. If your local rules state that competitive procurement has to happen at a threshold of $50,000, you replace this 250 with your 50 and then follow the same guidelines. That's the way that an auditor would approach evaluating your compliance with procurement. But generally speaking, as we go through here, there are 5 unique categories of or methods of procurement, and we'll kind of start at the low end with your micro purchases. These are the items where you're going to purchase directly from a known vendor. These are the types of things that may be done on a procurement card, if you have those, and those types of things. The risk is relatively low because the dollar amounts are relatively low. So really, the only guideline when you make these purchases is that you have to determine that the cost is fair and reasonable. So how do you determine that a cost is fair and reasonable? If you're going on and purchasing supplies off of Amazon, or you're going to the local grocery store and purchasing refreshments for a program event that you're going to do, it's assumed that by paying retail rates for those purchases, those rates are fair and reasonable. You would like to hope that the person running your local grocery store isn't inflating prices because they know you're using federal funds. If that's the case, let me know. I would love to have a conversation about that. But the assumption is it's fair and reasonable. Where the extra work for you comes in this category is if you are contracting for services or goods that are in the micro purchase kind of threshold limit. For instance, you may be contracting with a service that does translation for materials that are part of a program that you're doing. It may be a one-time use and the cost is going to be relatively small, but because there are no established kind of market rates for translation services that can be easily identified, you have to take the extra step of documenting that the rates that provider are charging you are fair and reasonable. And there's a few different ways you can do that. One way is by using what you've historically paid for similar types of services. Another is, doing an evaluation of, what market rates are available by calling and getting comparison quotes from other suppliers and that sort of thing. You just want to make sure that you've documented that the cost that you're being charged for that service or those goods is a fair and reasonable cost. The next step up from micro purchases are your small purchases. And this is anything that's under the simplified acquisition threshold or what you may have as your competitive procurement threshold. These ones, again, don't require a competitive type of procurement. You can go out and select a vendor that you want to use. The one caveat for these, because there's more money at risk that you're using from your federal funds, is that you want to make sure that you've done and you've obtained an adequate number of comparable rates or quotes from other suppliers that can provide the exact or similar comparable services and goods. And you want to make sure that you've captured an adequate number, which is unique to each individual procurement. But generally speaking, you want to be able to document some assurance that you've looked at the rates that are available and that the rate that you ended up selecting is within an acceptable and a reasonable degree of fairness of what market rates are for those goods or services. Next, we will kind of step into the formal procurement. These are your competitive procurements. And these really break down into two categories. On the one hand, you have the situations where you're just looking for the lowest price for somebody who can do this, who can deliver this service or provide these goods. And those are just simple sealed bids. Your RFP says we're taking the lowest price from qualified, providers. Submit your bids by this date. We'll open them all at the same time. We'll select the lowest bid. Because the lowest bid is qualified to do the work, that's who we contract with. Very straightforward. There also may be times where you want to consider criteria other than just cost. In those types of things, you would do an RFP or a request for proposal. This is a little bit more involved because before you do the procurement, you have to understand what are the eligibility criteria that you'll use to select a vendor or a contractor. Those eligibility criteria then are communicated as part of your RFP, and those providers who respond to your RFP need to provide responses to those eligibility criteria, so that when you collect all of those, again, you collect them all, usually sealed, you open them all at the same time, and you do an evaluation looking at cost as well as the other factors that you've identified as criteria. Rank the bidders based upon their responses, and then select typically the most advantageous proposal based upon price and their ability to meet those eligibility criteria that you've defined. Now, I'll talk real briefly about sole sourcing. Sole sourcing is when you should have followed a competitive process, but you didn't, or you're not able to. And there are very limited circumstances where that applies. In instances where there is only a single source that can provide the service, if there are emergency or exigent circumstances that prevent you taking the time to do a competitive procurement process, or if there's inadequate competition. One of the questions that comes up with the emergency or exigent criteria as it relates to sole sourcing for ARPA is, does the federally declared emergency for COVID-19 constitute an emergency situation that would allow for sole sourcing? And Treasury has made it abundantly clear that it does not. So that federally declared emergency does not allow you to sole source. So then we kind of look at some other avenues for sole sourcing. If your goods or services are only available from a single source. Now, keep in mind that you cannot craft your procurement to limit the number of or qualifications for people to respond to your procurement in order to narrow the field down, right? So when you're doing federal procurement, you can't show geographic preference. You can't limit to just people who live, who do business in my county. So it has to be, you have to do an adequate or make an effort to do an adequate, procurement of those services, but find that, there's only a single source or there's inadequate competition. Single source is very difficult bar to meet, and I'll give you an example. I am working with a client who has a statutory obligation to use a single provider for their indigent services in their courts. So your public defenders. There is no other firm in the state who can compete with this entity. So there is only one viable source that my client can procure these services from. So that allows them to use the sole sourcing or single source as an ability to sole source from that provider. also wanted to mention within adequate competition, you cannot base that off of a single procurement event. If you go out to procurement and you don't get enough qualified bids to make a competitive selection, you typically have to reevaluate how you bid it and go back out again. Making sure that you have done your due diligence to assure that the way that you present the procurement does not artificially limit competition. The other thing that's important about sole sourcing is you want to document your justification. When it comes time to audit, there will be a lot of scrutiny for your sole sources. If you're not able to document why you sole sourced it and why there was no other alternative, you're opening yourself up to those funds being deobligated. So just make sure that you've done the effort. You know, I oversay this. I think I'm going to get it tattooed on my arm. Document, over document everything, but particularly as it relates to sole sourcing. For a question was asked for micro and small purchases, do the vendors have to be registered with SAM? That is a great question. So typically, you should make an effort to make sure that you're not doing business with anybody who has been suspended and debarred. So from that perspective, kind of using not only SAM, but your any local or state requirements that you have for suspension and debarment, you want to make sure that those vendors are not kind of within that scope. As long as they're not, generally you're fine. There are some, presumptions you can make. Amazon is probably has not been suspended or debarred, so you're probably safe there. But anytime that you're doing business with an entity that may have exposure, it's reasonable to assume that they may have had exposure to federal contracts in the past, and there's a possibility that they could be exempted. You should definitely check them just to be sure. Another question came in. If we do not know if something will be ARPA funded, is it acceptable to put ARPA terms in contracts just in case? The ARPA terms you're probably referring to are the procurement, the contract requirements in 2 CFR 200 Appendix 2. Generally speaking, yes, I would say if you're unsure whether something is going to be ARPA funded or federally funded, it's better to put the terms in than to have to go back and add them after the fact or address compliance with them after the fact. So I would say, if you're not sure, it's better to err on the side of caution. Another question came in, when do particular federal requirements apply, i.e. procurement under 2 CFR 200, Davis-Bacon, prevailing wage, etc.? Anytime you use federal funds, 2 CFR 200 applies. So that's just a given. In terms of when do contract terms like Davis-Bacon, prevailing wage, domestic preference for procurement, and those types of things come into play, consult 2 CFR 200 Appendix 2, which has all of those contract terms. It will also provide you with guidance on when they do and do not apply to specific contracts. Each of those requirements are based on separate statutory or regulatory requirements. And so the application of when they do or do not apply kind of is on a case-by-case basis, but that is all detailed in Appendix 2 to uniform guidance. Okay. Somebody asked the question, can you address the order of evaluation for a bid? Should we first rank by price and then decide if they are reasonable and responsive, or first responsive and reasonable, and then from those vendors rank the pricing? If that's related to specifically to sealed bids, you always go with lowest price first. So whoever has the lowest price, if they all are also responsive and reasonable, or responsive and responsible, then that is who you would select. If they don't meet those minimum qualifications, then you can go to the next lowest and so on from there. Okay, you spoke about, so another question, you spoke about no local preference with federal guidelines. However, a large part of ARPA's focus is based on the rulings, and supporting information actually puts a large emphasis on putting the dollars back into your immediate local area. That seems contradictory, and you would think the specifics of the two guidance would override any initial preference by 2 CFR 200, which would encourage local preference. So the question basically says, you know, ARPA's focus is on, we want you to spend this money within your community to recover and respond. And at the same time, uniform guidance is saying, you know, you cannot show local preference. Yes, it's confusing. So the important thing to keep in mind here is you kind of have to separate those two priorities, right? The no local preference is designed to minimize the risk of a procurement being crafted for a specific vendor or group of vendors, or to otherwise limit competition. Whereas ARPA's guidelines of supporting and engaging with your community are really designed on around the intent of pushing as much of this funding as possible down to the beneficiaries, the people in your community who are going to benefit from it. So same but different, I guess, would be the answer to your question. Another question just came in. What would be considered appropriate documentation for SAM registration validation? If you do not already have a sam.gov account, you need to get one. When you go on and look up a vendor or a contractor within sam.gov, you will be able to go to any exemptions or exclusions, i.e. suspensions or debarments that are applicable, and they will be able to print out a page from sam.gov that either says there are no active exemptions, or that there are, and these are what they are. There's a ton of great questions coming in about procurement. Unfortunately, I want to make sure that we save time for everything, so I'm not able to answer all of these right now. If I don't get to your question, please contact me. At the end of this webinar, you'll see my contact information. You can call, text, email. I'm happy to answer any of these questions offline if I'm not able to get to them today. So let's keep moving a little bit here. The next area that I want to talk about with procurement is important as it relates to federal funds, which is socioeconomic contracting, which this also plays a little bit off of the no local preference question. Because of executive orders that are in place, there is a strong preference for socioeconomic contracting, which means in plain language, as we are doing procurement, we need to ensure that targeted firms, which are small business firms, women's business enterprises, minority-owned businesses, and labor surplus area firms, have a fair and competitive shot at those federal dollars, right? But you can't show local preference. So how do you make sure that they have a fair shot at those dollars without saying we're limiting this contract to targeted firms or something along those lines? Here is how you take and document everything, how you document your affirmative steps. First, you can start by creating a solicitation list if you don't already have them. When people register within whatever procurement system that you use, you capture their contact information. If they are one of these target firms, you include them on an email blast when you send out a procurement that they could apply to or that they could bid on. That is one way, that is an affirmative step that you've taken to make sure that you're inclusive of those firms without limiting competition within the bid. Another avenue that you can consider is taking the total requirements for a procurement and chunking them up, right? Building an entire building may not be something that a small business firm can do, but they can certainly do the framing piece. So if you're able to take a big project, chunk it up into smaller bits and do it as separate procurements, you increase the opportunity for those targeted firms to have more opportunities to apply or bid on those grants. I'm sorry, bid on those contracts. Another one, which I highly recommend that everybody does if you're not already doing it, is require your prime contractors to follow these same requirements. So when you select your general contractor for your building of your building, the construction of your building, make sure that the contract that they have requires them to target minority businesses, women-owned businesses, small businesses, and these other target firms as part of their contracting with subcontractors, right? So even if one of these target firms are not able to directly bid for a project, they could still be able to be part of that process by being a subcontractor. Okay. Stepping away from procurement and into eligibility for a moment. One real quick question on socioeconomic contracting. Somebody asked, are we required to reach out to hub vendors at any threshold? No, you are not required to. However, you are required to document that you have taken active steps to ensure a fair and competitive bidding environment. So you're not required you're not required at any threshold to reach out to them, but you do have to show that you've taken affirmative steps to be inclusive in your procurement. So I hope that answers your question. All right, I'm going to talk a minute about eligibility. So when we talk about eligibility, we have to understand that there are 4 broad categories of eligibility under ARPA. There's response to the public health and negative economic impacts. There are infrastructure projects, there is revenue loss, and there is premium pay. Within the first 2 categories, the public health and negative economic impacts, as well as the infrastructure projects, and to some degree within revenue loss as well, there's a wide spectrum of uses within those categories. And Treasury, particularly for the first 2, have enumerated specifically how to meet those eligibility requirements. As you are going through and allocating your funds to different projects and programs, you need to identify which one of those expenditure categories, as they call it in the Treasury portal, which expenditure category your project aligns to. And in order to do that, you need to understand and document how you arrived at that decision. The approach that DRS takes is an eligibility memorandum, and this is basically a breakdown of the framework that we use for that. We start out by kind of providing background, who the recipient is, what is the award. And we do that, and we do a lot of this because so much of the audit and examination of your use of this funds is going to come after 2026, right? So after you close out, that's when Treasury is going to start coming in and doing desk audits and doing examinations. And they have 5 years to do that. So, whoever is making that decision today may not be here in 2030. So you want to make sure that you have done the work to document what it is and how it is that you arrived at these decisions. So there's no guesswork. You have it clearly laid out how you arrived at eligibility determinations. And that's what this does. This framework provides kind of the background of who you are, what the award is, how you intend to use this chunk of money for this eligible use. What is the project or program that you're doing? We include definitions in our eligibility memos. And in fact, we do it in all of our memos. And the reason for that is because words have meanings, and those meanings are derived from context. So what we talk about, like for instance, with revenue, as an accountant, I know what revenue is. As an ARPA compliance person, I also know that revenue has a slightly different meaning. Get to that in a minute when we talk about lost revenue. Same thing for things like obligation. As an accountant, I know what an obligation is. As an ARPA compliance consultant, it has a slightly different connotation for this purpose. So we include the definitions here so that as you read through the rest of the memo, you know specifically the context that we're using certain words and phrases. From there, we get into the meat and potatoes of the eligibility memo. We do this in two sections. The first section is the regulatory scope. What does the final rule say we have to do in order to be eligible, and how does uniform guidance impact that, right? So as you're looking at a program or an eligible use category, it may require that you may meet the guidelines of certain other eligible programs. For instance, if you're doing affordable housing programs, you can use the presumption of eligibility under certain HUD programs to be eligible under ARPA. In order to understand if your program would be eligible under those other programs, you need to know what's in those other programs and how they define an eligible program. So that gets included in the scope of this. Things like determining what is a disproportionately impacted community. If that's a requirement for an eligibility category that you want to use, you need to define in the memo, this is what Treasury says, or this is how Treasury says we define a disproportionately impacted community. All of that is captured in that section of the eligibility memo, because in the next section, we apply all of those requirements to your intended use of funds. So if I have to define what is a disproportionately impacted community, this is the way I have defined a disproportionately impacted community for this program. It spells out exactly what it is, how we define it, how we measure it, and how that's compliant with what's in the regulations. And we do that for every step of the regulatory requirements for determining eligibility. And then at the end of the memo, we include a conclusions section, which just makes a statement as to whether the project or program would be likely or unlikely to meet eligibility requirements. And yes, we do memos for ineligible projects. And the reason for that is, if anybody ever comes back and says, why didn't you fund my program? Why didn't you fund my project? You were unfair. You have a document that says, this is how we made the determination. You did not, your program, your project did not meet the regulatory eligibility requirements, which is why it was not funded. And then that way it takes all of the guesswork of equality and inclusion challenges out if you can clearly show that a program or project was clearly ineligible for funding. So very important you're doing your eligible and ineligible, documenting your eligible and ineligible programs. Okay. Next, I want to talk about the next part of eligibility, which is cost principles. I'm going to go through this very quickly because I want to make sure that we save some time. But one of the things that we look at cost principles are the costs allowable, which means they're reasonable and necessary, and are they allocable, right? So allowable really gets to the heart of what's in uniform guidance. You want to make sure that you've looked at the cost principles section of uniform guidance, which actually details specific requirements and limitations and exclusions for classes of costs. So for instance, if you're doing tuition remission, there's rules about that. If you're doing compensation and benefits, there are rules about that. You need to know what those rules are and how to apply them to your use of funds. You also want to ensure consistent treatment. You should not have a separate set of rules for ARPA funds. They should follow the same cost and expenditure rules that you use for any other cost that your jurisdiction incurs. So that just making sure that the rules are applied across the board uniformly to costs. And then documentation, again, over documenting. You are required to document not only that you have an obligation to incur the cost, but that you actually incurred the cost, which means documenting an obligation through a contract, purchase order, an invoice, receipt, something along those lines, shows that you actually had something that you had to pay. Showing proof of payment means canceled checks, purchase card statements, wire transfer documentation, anything that shows that you actually did pay for this thing that you're submitting costs for. Reasonable and necessary. I'm going to go through these relatively quickly. They're pretty straightforward. With reasonableness, you want to use the sound business practices, or what's called the prudent person test, which is, would a prudent person at the time that a decision is made to purchase something, and given the circumstances that we know when we made that decision, decide that it is in the best interest of our local government or organization to make that purchase. That is what reasonableness is in a nutshell. It is also, making sure that you're following consistency with market rates and your own policies and procedures. Necessary means that this is something that you actually need to fulfill your requirements of your grant or the projects or programs funded there too, and that you're not doing duplicative purchases or unnecessary purchases. In other words, by an example, if your organization has an inventory of unused laptops, you cannot go out and purchase a new laptop if you have one that you can assign for the same purpose. Unless there is some reason that you can justify as why you would need to purchase a new laptop, you have to use what you already have, as opposed to using grant funds that aren't necessary to be used. And then allocable is the last piece of the cost principles, which is the cost that you're incurring is directly tied to the grant, either specifically to a project or program. You want to make sure that it is in the budget that has been assigned to that project or program. You wanted to make sure that the cost has a grant-related benefit, right? So this kind of gets back to the necessary component of it. Without purchasing this thing, we are not able to fulfill the intent of our project or program. That is a grant-related benefit. And then there's the question of direct and indirect costs, which is a whole separate webinar that we could do. But generally speaking, you want to be mindful of how you utilize direct costs. So to give you an example, if you were to hire DRS to provide you with support for your ARPA awards, that is a direct administrative expense that you can charge to the grant. If you have a staff member who is responsible, let's say, for budgeting, they have also been assigned duties related to ARPA administration. Unless you can identify specifically to the minute the time that they allocate between the two, then you are left with associating the staff member's time as an indirect cost to ARPA. And there is processes identified in uniform guidance on how you determine what is a direct and indirect cost, how you calculate your indirect costs, and how you apply them. So generally speaking, unless you already have a negotiated indirect cost rate with a federal cognizant agency, you are limited to using 10% of your modified total direct costs as indirect costs against your grant. And that would be booked to expenditure category 7.1 for administrative expenses. Again, an area that has a lot of nuance that we don't have time to cover today, but wanted to make you aware of that. So you can follow up with questions if you have them. Lost revenue, real quickly, I want to address this. The most important thing about lost revenue is understanding that you cannot use lost revenue to supplant your general funds or other funds that you have. Likewise, you cannot reimburse yourself with ARPA dollars for expenses that you pay out of general funds. If you use revenue loss, you have to use it for the provision of government services, which is to say the cost that you incur has to come from your ARPA fund, not your general fund. So by way of example, say you have a fire department that wants to buy a new fire truck. Instead of that $1 million fire truck being paid out of your fire department fund, you could pay it out of your ARPA revenue loss fund, right? Those costs are procured following federal requirements because you're using federal dollars for them, and the cost is allocated to your ARPA fund. Now, you would look at that and say, but I have this $1 million in my fire department fund that I was going to use to buy a fire truck. What do I do for that? And isn't that supplanting? No, it is not supplanting the way that Treasury has defined the final rule and structured revenue loss. So long as you are not commingling your ARPA dollars with general funds or other fund dollars, and you treat your ARPA funds as a separate fund category, and the costs that you incur from that fund are funneled through that channel and are consistent, the procurement rules and other requirements and cost principles are applied consistently, that is an ARPA expense and does not supplant your federal fund, and then you have an extra $1 million. Maybe you go buy another fire truck. It's important, very, very important to keep in mind that unless you have selected the standard allowance, you have to calculate your revenue loss every year, regardless of whether you spent it all or not. It has to be calculated and reported every year. In addition, regardless of what type of revenue loss that you have, it has to be separate from your other funds. ARPA is its own fund category, should be treated as its own fund category and should not be commingled with other funds. So if you have commingled with other funds, call me. We can talk about how to unwind that for you. Question that came up on this, is it appropriate to use the full award as revenue loss? So with revenue loss, yes, you can use your full award as revenue loss, so long as you either A, have selected the standard allowance and you have an award of less than $10 million, or B, you have not selected the standard allowance, which means you calculate your loss every year, and your award amount is less than the revenue loss amount that you calculate. If your award is greater than your revenue loss amount and your total award is more than $10 million, then no, there is no way that you can apply your full award to revenue loss. Again, there's some nuances there. Feel free to reach out to me if you have questions on those. Quickly going to talk about premium pay. I was going to try really hard not to make this a marketing presentation, but I will say premium pay is the single most difficult compliance risk area that I have seen with the clients that we work with and others that I've talked to across the country. If you've done premium pay, if you're thinking about doing premium pay, please reach out to me. If for no other reason, to have us come in and audit your process. The rules and how they're applied are so complex and convoluted. It's very easy to get compliance wrong on premium pay. Couple of things, even if you don't call me, which I encourage you to, couple of things that I would say, keep in mind. Premium pay is no longer an eligible cost category. As of the end of the public health emergency on May 11th of this year, you no longer can charge premium pay, right? So if you incurred premium pay prior to May 11th, that's fine, that's eligible. If you're still incurring premium pay as an eligible cost today for time that's being worked today, you're out of compliance. Call me, we'll talk about how to walk that back. The other big thing, and I see this so frequently, I have to address it. Premium pay is not for retention. Absolutely, positively cannot be used as a retention payment. If you use premium pay for retention, you are out of compliance. Final rule provides a whole different expense category or eligible use category for retention bonuses with its own set of rules and caveats. If you have called or considered your premium pay to be a retention payment, definitely call me. We can talk through how you can cure that issue. Very quickly going to touch on subrecipients. Again, I think this may end up being a whole separate webinar that we can do on subrecipients. The key point about managing your subrecipients is first, making sure that you've identified who your subrecipients are, that you know the difference between a subrecipient and a contractor, and that your subrecipients are actually subrecipients and not contractors. So that determination is a very important first step. Once you've identified a subrecipient for your program or project, you must do a risk assessment to determine whether they have any inherent risk or the level of inherent risk that organization has with complying with federal requirements, as well as any specific requirements that you impose upon the grant. The more risky they are, the more monitoring you have to do, which goes into the monitoring plan. Before awarding an agreement, make sure that you have done the work to establish what your monitoring plan will be and that it's included as part of your award agreement, so that the subrecipient knows what they're required to provide for monitoring and what the consequences are if they are found to be out of compliance. Then you make your award agreement. Again, another big area that I see, contractor agreements and subrecipient or subaward agreements are completely different animals. If you are using the same template for both, then one of them or both of them is probably missing stuff. So, if you want more details about the difference between the two, feel free to reach out to me. Happy to talk through that. I realize we're running close on time, so I'm going to kind of skip over this so we can talk deadlines for a minute. If you are able to stick on after the call, I'll stick around for a little while and answer some questions. But very quickly, monitoring and reporting of subrecipients is very important, and happy to answer any questions you have on that. You should be familiar with your reporting guidelines. The one thing I will say with reporting, earlier this year, Treasury said, oh, hey, all subrecipients and contractors have to have a UEI, which put everybody into a tailspin because contractors, unless they are already doing business with the federal government, are generally not required to have a UEI. Treasury has since walked that back to limit it to subrecipients. So your subrecipients must have a UEI. Please keep in mind that subrecipients are not required to make a full registration in sam.gov to get a UEI. They can be assigned one actually with minimal information from them. If they need help on doing that, I can show you how to do that. Feel free to reach out to me. Another big thing to keep in mind, up until this point, Treasury has used project and expenditure reports largely for generating press releases. That has changed and is changing with the report that a lot of us are actually getting ready to file on Monday, if not sooner. They are now looking at it for compliance concerns. So if there are some things about your project and expenditure report that need to be updated, feel free to reach out to me. We can talk about how to do that for your October filing. Okay, in a minute, I'm going to very quickly talk through deadlines. Couple of big ones, infrastructure projects. If you have a desire to do infrastructure projects, please start them now. The timeline for getting infrastructure projects done and obligated is quickly closing. Based upon our industry averages, design for infrastructure projects is taking 4 to 6 months. Construction prep and procurement is 6 to 8 months, and then construction is 24 to 36 months. Remember, and we'll talk about this in a minute with obligations, any changes to your construction contracts after December 31st of 2024 are new obligations and would not be covered under the use of ARPA funds. So change orders and the like need to be done before then. Okay, real quick, here is your ARPA obligation countdown clock. We have 523 days and 9 hours, 10 hours to go before obligations need to be finalized. Important thing to remember here, what is an obligation? Obligations are defined in uniform guidance as orders placed for property and services, contracts and subawards made, and similar transactions that require a payment. That's an important piece of it that require a payment piece, right? By the end of 2024, anything that will require you to spend ARPA SLFRF funds needs to be documented. You need to have a purchase order, you need to have a contract, you need to have something in place that says you are required to pay these dollars. After December 31st of 2024, you are not allowed to pay anything more than what you have obligations for, period, end of story, no new obligations. Change orders that increase costs, anything that would be new obligations, any payroll that's new in 2025, you cannot, use your 2025 and 2026 staff salary costs as eligible. Those are not obligated until they're incurred. So again, want to make sure that you understand what those deadlines are. So how do we prepare for the obligations deadline? First, know your timelines. What are the current timelines for your projects and programs? Is there any concern that they won't be finished by the end of 2024? If so, red flag those ones, monitor them, know what's going to stretch into the closeout period. Likewise, evaluate your budgets. Start tracking, if you're not already, start tracking your budget spend downs so that you can forecast where you are going to exhaust your obligated funds and know whether you're going to bleed into the liquidation period or not, the closeout period or not. And then document your plan. Know how you're going to address those things before you get to them. And then real quick, what happens? Oh, there's my timer's working again for a second. Real quick, last slide. We're going to talk about what is the closeout period and liquidation after December of 2024. These are the things you have to do. Identify the obligations with a balance to pay. What do you still have to pay down? What are you required? What are you documentally required to pay? Do equipment and asset inventory. Understand what you've purchased with your ARPA funds. Are any of those assets long-lived that you will need to monitor and take care of? Do you have any unused or residual supplies that you can liquidate? If not, make sure you've determined how you're going to address those. And then if you haven't already done so, make sure you close out all of your subawards with your subrecipients. They're following the same guidance for obligations and those types of things as you are. This, maybe go to the next slide. Yeah, there it is. Here is my contact information. You can call, you can text, you can email. Please feel free to reach out to me. I know we have a few questions. I'm going to stay on and answer a few of these questions. If you have to jump, I understand. No worries. If you want to hear me drone on for a little bit more, I welcome you to stay. Real quick, wanted to address some questions. One that came in, if you are using ARPA funds as a match for a federal program, does the federal funded project have to be completed by the 12/31/2026 deadline? Great question. Okay, so yes, Treasury has allowed that ARPA funds can be used as a match for a federal program so long as you are doing that under your revenue loss category. Okay, so yes, you can revenue loss ARPA funds for a match under a different federal program. If the project that you're using the match for does not have to end by 2026, however, the obligations that the match are being used to pay have to be obligated by 2024 and expended by the end of 2026. So yes, you can use ARPA funds as a match under revenue loss. Yes, your project can go beyond the ARPA dates, but your use of ARPA funds as your match cannot. So hopefully that is clear. If not, feel free to reach out to me and I can help you clarify that. Another question, and I really love this question because this is kind of like the secret part of ARPA that nobody talks about. Revolving loans for small business entities. These funds have been loaned out. There's interest being accrued and program income being generated. What happens if those loans extend beyond 2026? Okay, here's the cool thing I love about revolving loans. Treasury in their final rule has said that if you create a revolving loan program that meets eligible use under an expenditure category, right? So you followed all the rules. The ARPA funds are considered obligated and expended on the date that you disperse the loan. Furthermore, you are not required to report program income on a revolving loan program, which means you go out and set up a small business revolving loan program using ARPA funds. Those funds, as long as those funds are obligated, and i.e. the initial loans are made before December 31st of 2024, and you've dispersed those loans on the initial set of loans by the end of 2026, any repayment of those loans can go back into the revolving loan program and be used in perpetuity without any further obligations or requirements from Treasury. This is the single way that you can create a long-lived financial benefit for your community using ARPA funds. ARPA funds are generally designed to be one-shot projects that meet immediate needs. This revolving loan program is not talked about much, but it does provide you with a way to set up something that could potentially have long-lasting impacts for your community, whether you use it for small businesses, whether you use it for workforce development funds to get your residents, educated and qualified for better jobs, whether you use it for, child care programs. As long as you follow the ARPA guidelines, you have a lot of leeway there for how you use those funds. Let's see, Corey, have you seen some interesting questions here that I could answer before we go?
We've got there's a decent amount. In the Q&A thing itself, there's a handful. There's some that have been sent through the chat that you may not have had the chance to see.
Okay, I'm going to go through here real quick in the Q&A and pick some of the easy ones to get those out of the way. Do subrecipients have to have all of their funds obligated by 12/24? Yes, they do. Subrecipients have to follow the same rules that you do for their use of ARPA funds. So yes, they do have to do that. They have to follow the procurement requirements as well as the cost principles. Do procurement requirements apply to revenue replacement funds? They do. Remember, your revenue loss, revenue loss is not despite Treasury sometimes calling it a replacement, it's not actually a replacement. What you're doing with revenue loss is you're calculating a bucket of eligible expenses that you can incur under that category, right? So those expenses still have to follow the uniform guidance requirements for cost principles, for procurement. They're still subject to audit and deobligation. So just because it's revenue loss doesn't mean you're out of the woods. The nice thing about revenue loss, though, is Treasury has said any project that would be eligible under any eligible use category can also be done under revenue loss with reduced administrative burdens. So for instance, if you have a project that you were going to do under a economic impact category, and it requires you to do a written justification because it's a capital expenditure over the threshold, you do not have to do that written justification if you treat it as revenue loss instead of the other category. Keep in mind, though, your revenue loss is limited. The expenses you can put under revenue loss is limited by either your election of the standard allowance, which is 10 million, or by the actual revenue loss that you calculate. So, you can very quickly exhaust all of your revenue loss threshold. So just be mindful of that. Yes, obligation time frame count towards revenue loss. It does. Yep. Treasury's FAQ 13.15 says that revenue replacement dollars be managed in accordance with local policy and a few applicable sections of uniform guidance, not equivalent to federal funds. Those applicable sections that they're referring to are cost principles and procurement requirements. Also, if you engage in a program that would be considered provision of government services, and it involves a subrecipient using your revenue loss dollars, that subrecipient rules would apply too. So the real thing about the revenue loss component and the broad latitude, as Treasury calls it, for using those funds is it just reduces some of the administrative burden in managing your ARPA funds, right? So you don't have to collect demographic data and report it. You don't have to report individually contracts and subawards and individual awards over $50,000. Like those are the administrative conveniences, some of the administrative conveniences that you get by using the revenue loss category. Okay, a question came up. Do you use these eligibility memos for each beneficiary or just for the project activity? Generally, it's just for the project activity unless you're doing something that is unique for a specific beneficiary, right? So for instance, if you're doing an affordable housing initiative and that entails, 3 different developments that are being constructed using your ARPA funds, each one of those individual developments would have an eligibility memo as opposed to the program as a whole. But the flip side to that is like if you're doing a workforce development program, we would just consider the workforce development program as a single project with a single eligibility memo. How long can sole sourcing be in contract, and can they renew after the end of the term? So sole sourcing, if you are able to have a program that is, or I'm sorry, a contract that you can justify as sole sourcing, it is for the term of the sole sourcing applies to that procurement. So whatever the terms of that procurement are, keeping in mind that if that sole source contract goes beyond the period of performance for ARPA 12/31/26, you can no longer use ARPA funds for those costs. So even if you've obligated something by 2024, but the costs are not actually incurred, it means you don't actually pay the costs until after 2026, you can no longer use ARPA funds, right? So by whatever money, ARPA money you have sitting in the bank on 12/31/2026, that is going back to Treasury, regardless of any obligations or contracts that you have. Okay, I'm gonna keep going. Did that one. Let's check the chat real quick. Okay, if they only have a valid UEI, but no active registration. How do you verify suspension and debarment in sam.gov? Great question. So as I mentioned, it is possible for a subrecipient to get a UEI without actually registering sam.gov. They only have to register if they're going to do business or receive assistance directly from the federal government, which means if you just go in and apply for a UEI to have a UEI, when you go to search for that entity, it will come back with, I believe the way that it currently shows is that this is a valid UEI, but there is no active entity. That is your proof that they have not been suspended or debarred, right? So if they're not actually registered to receive money directly from the federal government, then the federal government cannot suspend and debar them. So there would be no exception for them. So hopefully that answers your question. To confirm, contractors do not need a UEI anymore, only subrecipients. Yes, that is correct. With the new announcement that Treasury made, I believe it was in June, it is now only limited to subrecipients. However, your contractors still need a tax ID number. They cannot use DUNS numbers anymore. That's been phased out. So they do have to use your tax ID number. Where that gets to be or could be problematic, if you have an independent contractor who does not have an LLC or some other type of legal state entity, and they use their social security number as their tax ID number, they have to provide that to you, and you have to report it to Treasury as part of your reporting. So I know people are sensitive about identity theft. If you have a contractor who only has their social security number, they can either apply and get a UEI and use that, or they can register an LLC and apply to IRS to get a tax ID number. But you have to have something. The question is, so there's no provision for administration of project past 12/31/24. That's a good question. I think what you're asking is, can your staff continue to support the administration of ARPA projects into past the obligation period, right? That's a great question that Treasury actually hasn't answered yet. So technically, because your hired staff do not have an obligation, you don't have an obligation to pay them until they actually work. That would mean that anytime that they spend on ARPA in 25 and 26 would not be eligible. The flip side, if you hire a firm like DRS to assist you with administration, you can obligate those funds in 2024 to assist with the closeout period through the next, I would say, 3 years, because audit will go into 2027. So you're looking at 2 years of the closeout period that you could have a third-party contractor providing you administrative support, and then potentially whatever's in 2027 comes out of your general funds. So that is an option for you if you need administrative assistance into 2025 and 26, and you want to use ARPA funds to pay for it. If funds are included in contract as contingency, does a contractor that draws against this okay even after 12/24? Okay, so it depends on how the contingency is set up. Generally speaking, yes. If the contingency is part of the agreement and you have an obligation to pay it, and there is, the contingency is a set dollar amount, right? So if you're saying there's a contingency of 10% of costs incurred, that would probably not be sufficient. But if your contingency is $200,000, then yes, that would be sufficient. So as you're getting to the end of, or as you're developing infrastructure projects now, and you're doing those contracts, you may want to provide a contingency within the budget to allow for that. So excited to see so many of you hanging with me. I'm going to try and get through more of your questions as much as I can. Yes, super excited that you're setting up a revolving loan fund too, Mary. That's awesome. Let me know if you want some ideas around that. I have so many programs I want to do. Let's see here. Okay. Yep. Yep. So the subparts D and E that uniform guidance so this is the question about revenue replacement and only a subset of the requirements in subparts D and E of uniform guidance apply to the use of funds. Generally, these requirements provide that recipients should not deviate from their established practices and policies regarding the incurrence of costs, and that they should expand and account for the funds in accordance with laws and procedures for expanding and accounting for the recipient's own funds. Recipients' use of revenue replacement funds remains subject to the other applicable requirements of the SLFRF program, including, among other things, the deadlines for obligations and expenditures and the application of federal anti-discrimination requirements. That was left vague enough to allow for interpretation. Generally speaking, because Treasury hasn't exempted specific requirements under uniform guidance as it relates to procurement and cost principles, it's better to err on the side of caution and use those even for your revenue loss application. So happy to talk through nuances of specific situations that you might have. Like I said, I love talking about this, so I love playing with scenarios. All right, okay. Gonna come back over to the Q&A since we still have a few people hanging on. I love you guys. All right, real quick, want to verify that ARPA funds can be used for engineering permit fees. They can be used for engineering permit fees on an eligible project, right? So if your project is eligible under ARPA, the fees associated with executing your project would be eligible. The final FAQ says SLFRF funds are not subject to 2 CFR 200-305, which addresses interest-bearing account and uses of interest, but does specify if the funds must be in an insured account. We would like to invest our SLFRF funds in our Texas local government investment pools, as we do with most of our city funds, but the pools are not insured. Is this allowed? I'm not familiar with the Texas local government investment pools. I'm happy to do some digging and get you a more specific answer. But generally speaking, if you're telling me they're not insured, then no, you would not be able to invest in those funds. However, you can put your ARPA funds in an insured, interest-bearing account, and those, as mentioned in the question, the requirements around the use of interest would not apply to any interest that you earn on those funds. The question was asked about quarterly reporting. I have questions related to the obligations inquiry to be reported. I've emailed the customer service email, but no response. I don't know who asked that question. If you're still on, reach out to me. I'm happy to answer the specific questions that customer service is not answering for you, and talk a little bit more about quarterly reporting with you directly. Okay, a question in the chat: can the revolving loan be to a city department as public works, etc.? So the revolving loan program that you set up has to be eligible under an ARPA or an SLFRF eligible use category, right? So if it is something that meets that requirement, theoretically, yes. Generally speaking, a loan to yourself or to a component unit of your government will probably not be considered eligible. But I'm happy to talk through your specific use case and see if maybe we can figure out a solution for you. Quick question on duplicates. We are looking at stormwater spending with a micro purchase threshold. If we purchased a manhole cover 15 different times for 15 different locations, do you think that would be a problem with that duplication? No, it would not be a problem with duplication because you're buying unique manhole covers for unique locations. The implied question, or the implied question there is, can we take a purchase and break it up into smaller chunks to get it to a smaller purchase threshold? And the answer is no. I spent 20 years as an auditor, and one of the first things that I look for when there are purchase threshold requirements is how did they try to get around those threshold requirements, right? So if you're purchasing all of these manhole covers at the same time from the same vendor, and you break it up into 15 different purchases to get them to be micro purchases, that's definitely going to be a finding that will get you into trouble. So just be careful with that, making sure that you're not trying to chunk up a single cost like that in order to get out of procurement requirements. Okay. Do landlords have to get a UEI number? It depends upon how you are treating the landlords. Generally speaking, I would say, I don't know what your specific program is, but if you're talking about landlords, they are probably not subrecipients. So my hunch would be that the answer to your question is no. And again, keep in mind, if your landlord is a beneficiary through like an affordable housing program or rental assistance program, they're a beneficiary. They're not required to have a UEI. They will have to provide you with a tax ID number, though. If you pay them more than $50,000, you'll have to report them individually. So better to just go ahead and get a W-9 on the front end instead of having to ask for it later. Okay, I think I answered the question about who's required to have a UEI, but if you have more, need more details, let me know. Okay, if we give a developer or a nonprofit $1 million for property purchase for homeless housing, does that have long-term federal requirements, i.e. it sells several years down the road, does the government have to be reimbursed? Wow, that is a great question with an amazing amount of nuance that goes into answering it. V. Hoffman, please reach out to me individually, and I will talk to you about your program. Answering your question largely depends upon how you've structured your program, whether you've used the eligibility requirements of other HUD programs to substantiate eligibility under ARPA, and some other nuances that are kind of really too detailed for me to get into in the next couple minutes, but I'm happy to talk to you offline about it. Is premium pay able to be issued after May 11th if eligibility is distinguished as employees who have been hired through the end of the declaration of public emergency period? Okay, so a quick clarification on premium pay. Premium pay has to be tied to a specific period of time in which the employees who are eligible experienced increased risk of COVID, either due to being working on site or within the public, or handling materials that had also been handled by another person, right? So you have to be able to tie premium pay as, we are providing premium pay to employees for the period of January 2022 through June of 2022, right? So that's your period where you're paying your employees your premium pay for, right? So all of that to say, if you are trying to reimburse somebody or pay somebody, I should say, if you're trying to pay somebody premium pay for hours they're working today, or any hours they worked, or any time that they work after May, after the end of the public health emergency, that will not be eligible. It simply is not eligible anymore. Happy to talk through your unique situation if you want to reach out to me directly. The question came up, Treasury lumps all payments to individuals, so we are not reporting their social security numbers. If an individual is a contractor, or if an individual is a beneficiary who has received more than $50,000 from you in ARPA funds, you do have to report them individually. You do have to report any award made to any class has to be in excess of $50,000 has to be reported individually in your project and expenditure reports. If you're not doing that currently and you need some help with getting caught up on that, let me know. All right, the hangers on. Got a few more questions here. Appreciate you guys. Can ARPA funds be used for affordable housing developer fees? Yes, under specific scenarios in which that would be an eligible expense. It largely, again, with affordable housing, kind of just as as complex as lost revenue or premium pay. It largely depends on how you've structured your program. So happy to talk to you, Kristen, if you want to reach out to me. Under the revenue loss category, can we apply this to payroll for staff that was originally budgeted in general fund? Would this be considered supplanting? We are looking to use this as an option at 12/31/2024 if we have not encumbered all funds. Okay, great question. Can you apply this for payroll for staff that was originally budgeted in general funds? Yes. So the whole point behind revenue loss is it's for the provision of government services. That's what the cost should be. And what you would normally provision for your government is what you would budget in your general funds. So as long as it meets that requirement, yes, it's totally fine for you to utilize revenue loss in that manner. Again, keeping in mind, those costs move out of your general fund and into your ARPA fund and our ARPA costs at that point, right? So whatever you've budgeted in your general fund for those salaries, those funds are now not encumbered to anything because those costs have been moved off. So depending upon how your specific organization handles your encumbrance of budget dictates how you reconcile those funds, right? So on one hand, you may be able to repurpose them. You may be able to move them forward into your next, budget year, but those are kind of unique to your organization. Happy to talk to you individually on how to address that. Question, normally we have 10% supplement work allowance for construction contract for change order might come up. Does this SWA eligible as far as obligation requirement? It depends on what the 10% is. If it's 10% of the contract cost, or it's 10% of the contract, then yes, when you make the obligation, that 10% is defined by whatever the contract amount is, right? So if your contract is $1 million, you know what 10% of $1 million is, that's your obligation. If the 10% is based on costs incurred or any other basis that would not be quantified until after December 31st of 2024, then no, that 10% would not be be able to be obligated after or be able to be used from ARPA funds after December of 2024. Yep, 10% of contract. Yep. So you should be okay with that. Okay. I think, wait, is that all the questions? I've gotten through all of the questions. Awesome. Thank you all so much for coming, for hanging on for an extra 15 minutes. I hope this was worthwhile to you. Please feel free to reach out to me if you have questions, if you have feedback, if you want to talk through your individual scenarios, and also if you're interested in working with DRS. I have a team that is more than happy to help you with whatever ARPA challenges you have And I can guarantee you that almost all of them love it as much as I do. So please feel free to reach out to us. I look forward to hearing from you. And thank you again for joining us today.